the large deficits in general are stimulatory. So the fact that money's pouring out into the economy through Social Security, Medicare, defense, that goes to seniors and their consumer spending. That goes to the healthcare sector and their workers and their spending. That goes to the defense sector, their contractors, their employees, all of their personal spending, interest expense. That does kind of pour out into the economy and stimulates certain parts of it. So the challenge here is that to actually cut those bigger four, it actually is there's unpopular decisions to be made.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest has long been warning that the US, as well as many other countries, is now in an era of fiscal dominance. That's when fiscal spending gets out of control, like a runaway train. It becomes so large that it becomes the primary determinant of economic growth and inflation, steamrolling over any impact of monetary policy or private sector lending. At the time of this recording, the deficit for the 2025 U.S. fiscal year is on track to be the third largest in history, only behind the COVID emergency spending years of 2020 and 2021. The key difference, of course, is that this time we're not facing a global pandemic and economic lockdown. Yet the profligate deficit spending continues unabated. What impact is this having on the economy, asset prices, our currency's purchasing power, and social stability? For answers, we're very fortunate to welcome back to the program Lynn Alden, investment strategist and author of the book Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. Lynn, thanks so much for joining us today.
Thanks for having me back. Always happy to be here.
Thank you, Lynn. Very much appreciate that. And look, we're going to get into cover as much territory as we can today. But I'm going to let folks know that one topic that we're not going to address today, because we're going to address it in depth at the upcoming Thoughtful Money Conference that you are speaking at. We're going to reserve your thoughts on Bitcoin and crypto for that conference. But folks, yes, Lynn is returning as one of the esteemed faculty members for our online conference. Again, that's coming up on Saturday, October 18th, so it's just a few weeks away. Again, we'll be diving deep into her thoughts on Bitcoin and crypto, and there's lots to talk about there right now. If you haven't got your ticket yet, just go to thoughtfulmoney.com/conference and buy your ticket there now, and buy it there soon so you get the lowest early bird price discount we're offering while it's still around. All right, Lynn, I was thinking about how to kick off this discussion with you, and was looking back at your book and realizing I think we've pretty much coming up on the 2-year anniversary of that book being published. So I'm curious, have things unfolded since then pretty much as you expected, or have there been any things along the way that have surprised you?
So they have. Yeah, we just passed the 2-year mark, and it's certainly been a fun ride. I purposely wrote the book in such a way to make it as timeless as possible. So
Hmm.
instead of kind of predicting what's going to happen 1 year, 2 year, 3 years out, it was basically really high level view of what money is, how technology changes structures of money and power over time, and how things, could look like years and decades in the future, and what kind of the big branching decision points are. The part that's probably most relevant for these past couple years is the chapters, kind of the middle chapters of the book, which focus on the U.S. long-term debt cycle. Your intro talked about the fiscal dominance that we're in, so that has continued to play out. In addition, the uh, the trade deficit aspect. So I had a chapter called "Heavy is the Head That Wears the Crown," which of
Hmm.
course is it's a much older reference, but that goes kind of to the idea that the U.S. structural trade deficits are indeed a pretty big deal, and they're kind of tied to the global reserve status. And so since that book came out, obviously trade has been greatly elevated in political discourse, largely because of the Trump candidacy and then the administration. The other factors that I published Broken Money during a deep Bitcoin bear market, kind of wrote it and published it during a bear market, and of course Bitcoin has more than quadrupled since then. The book takes a pretty favorable view on the asset, so I would say that's not surprising, even though I wasn't trying to make 2-year predictions with the book. Um, so a lot of things are kind of going as expected, for better or worse. Some worse, some better.
Okay. I was going to get to this later in the discussion, but let's bring it up here since you mentioned it. So one of the things that's different since you published the book is we have a new administration in place that has quite different economic and trade policies than the administration that was in power when you wrote the book. Um, what What's your general reaction to the new administration's policies? And maybe if we could start, what letter grade would you give the policies, looking through the lens of the broken money thesis?
Oh, it's hard to give a single. I mean, there's so many policies, it's hard to give one grade. I think the priorities that they're tackling from a fiscal sense, I think make a lot of sense. I've been on record before saying that I think, for example, the fact that the Trump administration elevates trade as being a pretty big deal is the one of the right things to focus on compared to prior administrations. Their solutions for addressing it, I think, are more mixed. That's why I'm probably more critical of their actions. And we can also kind of compare their outcomes compared to their expectations. So a lot of things untangle there. One, we a partner with Sam Callahan, and we published a report. We wrote it in 2024. It was published in January 2025. It's basically talking about the fiscal dominance thesis, kind of reiterating the nothing stops this train fiscal dominance view that I've been talking about. And it kind of broke down why DOGE wouldn't work, the Department of Government Efficiency. That was kind of
Hmm.
back during the peak publicity for that. That was kind of the peak optimism. We broke down kind of mathematically why that was very unlikely to work. And so in the months that followed, that all kind of, it had obviously shock and awe, certain political implications, but in terms of actually impacting the budget deficit, mostly a nothing burger. They were originally throwing around numbers like cutting 1 trillion off the deficit within a couple years.
I
Um,
think 2 trillion was even the starting number,
yeah,
but it
two
kind of
trillion was the
shot down.
starting
Yeah.
point. Yeah, we quoted that, and then they were kind of bringing it down to like 1 trillion. But it's mostly going to be a rounding error. Other than certain political things were targeted, but from an actual number standpoint, because they, as we point out in that report, they couldn't go after the key things, really. Social Security, Medicare, defense, interest expense. They were going after the slice of the pie chart that is not the biggest thing. Not to say that there's no waste there, of course, any sort of large entity, this is going to have plenty of waste, but actually the biggest area of spending tend to be lower employees and major transfers. Social Security,
Hmm.
Medicare, that's not where there's lots of employees, but that's where a lot of money's spent. And so that kind of is going along as expected. The tariff one's interesting because Stephen Miran, he was Trump's chief of his Council of Economic Advisors. Now, of course, he's his Fed appointee. He published an interesting report back in November 2024, so right after the election, that kind of walked through how you would restructure trade and what the risks and kind of approaches there are. It's kind of a more academic treatment of the subject. Um, and they intended that when you're kind of doing this big tariff policy, you'd likely get a stronger dollar. It would increase your negotiating position. You could get all these deals in place, and then you could have some sort of Mar-a-Lago accord, weaken the dollar, and go toward kind of a more, kind of back to a global, to kind of a new global system with those negotiations in place.
Hmm.
Um, the challenge is that the dollar weakened during the tariff negotiations, and a lot of the deals are more like kind of optical understandings rather than kind of detailed breakdowns. So it's more of a headline driven administration, especially when we talk about fiscal stuff or economic stuff. The thing I probably monitor closely, the most closely, is the tariffs, because those are some of the numbers that affect macro scale things pretty significantly. When you go from an annualized tariff rate of tens of billions of dollars to hundreds of billions of dollars as we have, that does have kind of economic and macro implications. So I've been tracking that pretty closely. There's upcoming kind of Supreme Court decisions potentially, so those will be kind of interesting to watch.
Okay. Supreme Court decision aside, do you have a distinct point of view on the tariffs on a net basis? Are they a net good thing because they either help us negotiate better trade deals, although it sounds like you think we're not getting substantially better trade deals, or it's bringing money into America's coffers, or are you more on the side that look, it's a tax on the American people at the end of the day, it puts friction in free trade, maybe it pushes some allies of ours into the hands of others?
So I think it's mostly a tax on Americans. Now, there's a data you can look at to see what kind of proportion it might be, and it's a moving target over time. So what complicates it is when the tariffs are being kind of considered, there was front running of imports. Rational entities said, well, tariffs might be coming, so let's buy a lot of stuff in advance. So quarter one of this year was kind of a stocking up quarter.
Right.
Then of course, we're going through quarters two and three, finishing up three here. Um, so the numbers are kind of all over the place. Aside from the weaker dollar, which weakened a lot this year, but it only went down a little bit since Liberation Day.
Hmm.
There really hasn't been a case, like a broad case of foreigners paying the tariffs, right? So in order to offset, say, 15 or 20% average tariffs, you need greater than 15 or 20% price decreases. Um, and so there's been kind of minimal to any foreign reduction in prices, meaning that they're not really eating the tariffs on their margin side per se. It's still possible they could eat it on their volume side. But so far, it's mostly a tax on Americans. I think the bigger impact is that it affects the deficits more so than it impacts trade. One of the complicating things is if you're a capital allocator making a multi-decade decision to do some sort of big Capex, it's hard to make that call if you don't know if tariffs are going to be in place for 1 year, 2 year, to the end of the administration, or into the next administration. It's hard to kind of do that calculus to determine what to do. So that's kind of been the most challenging thing quantitatively when you look at, say, 30 billion a month tariff. That's 360 billion annualized, potentially trending a little higher. That's up against a $2 trillion deficit. So it's not immaterial, but it just kind of
But
mildly
it's not
slows,
enough.
yeah, mildly slows the train. And I think a lot of people would rather see some of that in especially things that affect, the majority of Americans. I think they'd rather see it in trimming certain things than raising taxes, while keeping spending kind of fully going. So, that's kind of where I'd be somewhat critical from a fiscal standpoint.
Okay, smaller question followed by larger question. Um, Given your point about sort of the reticence of corporate executives to commit CapEx in an environment where things are still uncertain, and we know for sure from reports, surveys and whatnot, that they were not making a lot of capital allocation decisions in Q2 and probably still somewhat in Q3. Is there a lag effect from that? In other words, there's economic activity that otherwise would have happened that didn't happen and might still not be happening. And so, is there a lag effect that we should expect on the economy in the next coming quarters where they'll be slower than they otherwise would have been because of that delayed of activity?
I think yes, but that's only one variable among many. The large deficits in general are stimulatory. So the fact that money's pouring out into the economy through Social Security, Medicare, defense, that goes to seniors and their consumer spending. That goes to the healthcare sector and their workers and their spending. That goes to the defense sector, their contractors, their employees, all of their personal spending, interest expense. That does kind of pour out into the economy and stimulates certain parts of it.
Hmm.
But then, yeah, there are other drags of basically uncertainty is a drag. Um, PMIs are still fairly weak. We've seen a little bit of an uptick in initial jobless claims, but still the labor market is overall in decent shape. Um, and the majority of these things, like a lot of investors will have a very political lens on how they view things. And while politics does matter, it's kind of like the 80-20 rule. Like a lot of these things are bigger structural things that kind of cross administration. So, for example, with say oil and gas, one thing I think the administration's been better at has been being more allowing of drilling and things like that.
Right.
But a point that I've
Pro-production.
exactly, but a point that I've been making since the prior administration was the kind of the fact that U.S. production's kind of peaking and kind of rolling over is more of a private sector decision. So the constraint wasn't necessarily, at least except for around the margins, it wasn't really that kind of from the administration.
It
It was
wasn't the
more,
government policy that was the limiter. It was
y-
the corporate decisions. Yeah.
yeah, and that was mostly due to price, which is, basically without kind of there. Back in the 2010s, they were kind of very liberal on putting money back into the ground. So drill more, increase the price. Now, shareholders they generally want better balance sheets, dividends, share buybacks, and to only drill when there's a pretty high ROI associated with it. They want profitable drilling,
Hmm.
and at current prices, large parts of it is just not a very high conviction decision. So they've been more reticent to drill. Now releasing some of those frictions on them could around the margins keep them more elevated than they might otherwise have been in some sort of counterfactual. But a lot of these things are structural, that they're more price driven. So depending on what's happening, in the broader market, or they're demographics driven in the case of large swaths of the deficit. And so these things, while political changes matter for a lot of this, it's kind of that's kind of the part of the iceberg we see and everybody focuses on, and it's headline driven. Whereas the bigger part of the iceberg is that underneath part that's kind of more structural in many cases.
Right, and you can chip away on the ice above the waterline that you can see, but you're not affecting the majority of the mass of the iceberg. All right, I'm gonna continue mangling my analogies here. So I said in the intro that the fiscal deficit's sort of like a runaway train. That obviously was an homage to your line there, Lynn, that nothing stops this train. And you're kind of, in that case, you're comparing the train to our fiscal deficits, that they're, hey, for many reasons, some of which you've already alluded to, they are likely to continue going forward until this experiment, has a reckoning. And we can talk about that perhaps in a moment. When you envision the train, is the train primarily made up of four cars, being those big four you mentioned: Social Security, Medicaid, Medicare, defense, and interest on the debt?
For the most part, yeah. Medicaid, I kind of lump in with Medicare somewhat. That's a little bit more trimmable, as we saw in the recent like the Big Beautiful Bill tackled Medicaid a little bit. So that one's kind of the one that's a little bit more negotiable of them. Yeah, but it's mostly those big areas. And everything else in the pie chart, you can trim little bits of it, but those are rounding errors compared to those really big things. You can also lump in veterans benefits in with defense. It's kind of like our past defense decisions now give us obligations.
Yep.
And so those are the really big, hard to cut areas. And I think one of the the premises behind DOGE was the idea that there's so much waste that we can cut things that are not really popular. The other way around, that we can avoid cutting things that are popular so we can trim expenses without really feeling it. That was kind of the thesis. It's kind of like growing away out of the debt. It's something that you can commit to that doesn't actually promise to punish anyone or lose votes.
Right.
Like who isn't against growing, or who isn't against cutting waste, right? And if
Right.
you kind of
Removing
state
fraud. Who's going to be on the pro fraud ticket? Yeah.
exactly, so those are good things optically. But then the question is, when we talk about this $2 trillion deficit, how much of that is waste versus how much of that is popular programs going to voters that vote for those things, or lobbyists that pay to get those politicians and to keep that gravy train going. The biggest sources of waste are in basically the healthcare and defense areas. Social Security is just more of a demographics issue. It's basically past decisions of how they tweaked the payouts and things like that. They always kind of
Hmm.
assumed larger generations, whereas we got obviously a lowering birth rate, a more shrinking generation thing. So the challenge here is that to actually cut those bigger four, it actually is there's unpopular decisions to be made, either against voters in some cases, or against major lobbyists in some cases, or against when it comes to defense, every congressperson that has anything in their jurisdiction that might be receiving, defense related spending,
Yeah.
is going to try to
Like the
protect
jobs
it,
issue. Yeah.
whether or not it actually contributes to our national defense effectively or not.
Yeah. Yeah. Okay. So, but again, point being, those four things are by far the biggest, right? They make up the bulk of the iceberg
Yeah.
that's under the water. Going back to that analogy, and while there probably, is some fat to trim off of there, and we know DOGE has tried to do that already, and Big Beautiful Bill and a few other things are doing that. But primarily, you're saying, it's mostly muscle and bone, and so to the extent that they're hard to cut because they're painful like that, it's muscle or bone. So you either have to basically default on your commitments, right, to a certain extent, like, hey, we're going to means test Social Security. You're not going to get it till you're older or whatever, or we're going to cover less things and Medicare, whatever, which highly, highly unpopular. Uh, and then I guess in the case of the national debt, I mean, it explains why the administration is so hell bent on trying to get bond yields down, particularly, on the short end with the Fed, so that it can, at least in the short term, start rolling over debt over at a cheaper rate in the short term. So there is some stuff that can be done there, but that's hard to do. You can't just pull out a wand. You can't lower the bond yields by executive order, right? So this stuff is really hard. Okay, let me ask you this, Lynn. So I'm sorry. Where I was going with this is that's kind of why you get to this no one stops this train, right? It's just the political will just isn't there to cut the bone and the muscle the way that it would need to be done to get that stuff down. And in certain cases, there are things that the administration just really can't control. It can't control really the demographic makeup of the country. It can't really control where the 10-year is. I mean, there's some stuff it can do around the edges, and maybe if it got super draconian, but then or interventionary, but then there would be other prices to pay. So you come to the conclusion that, well, yeah, like we're kind of stuck with these runaway deficits for the foreseeable future.
Yeah, they're a Gordian knot that's very difficult to untie. The interest expense one's interesting because every point cut on the short end obviously will cut the short end part of the debt, but it doesn't necessarily cut the long end
Right.
portion of the debt. Now the Fed could do outright yield curve control if it's kind of pushed to politically. That's kind of a loss of central bank independence. And it has certain inflationary implications when that happens. So there's no free lunch there really. Um, and probably the longer term, I mean, it's salvageable in the sense that very long-term decisions could eventually, along with basically certain defaults and devaluations, get it under control in the sense that like healthcare is one of the biggest areas where long-term efficiency gains could be helpful. Not just in terms of like, firing some employees or things like that, but it basically in terms of the country being healthier. I mean, on Twitter, you're always posting your lifts, which is very are impressive. Basically, one of the structural problems we have in the U.S. is that our healthcare costs are like the most expensive in the world, despite at least for the majority, not necessarily having better outcomes. So not like longer life expectancy,
Right.
not
Poor
lower.
outcomes. Sorry,
Yeah,
but I
yeah,
mean, it's not even not as good, or yeah, it's not better. It's actually versus most of the developed world, we're worse.
yeah, worse on average. On certain leading edge things, we're near the top,
Sure.
and in certain times, but it's very heterogeneous. And it's part. I mean, it's a diet issue. It's our specific structure of the healthcare system issue. And some of that long term, if there's a lot of people kind of focusing on it, could be untied. That Gordian knot could be cut. But that's I wouldn't have optimism that's going to be undone anytime in the next few years. So in any sort of, and then it would take years to actually probably have its kind of positive effects manifest. So in
Sure.
any
And
sort
sorry
of,
to interrupt, but I'm just curious also, given the lopsided demographics we have right now and the fact that most of your medical costs are in your last years of life, we have like 20 years of the largest generation entering their last years of life, right? So there's going to be just a big bill to be paid from that alone.
exactly with the one caveat that, for example, Japan is the median age there is 10 years older, and they pay a smaller fraction of what we do for healthcare, because a lot of it's health, a lot of these kind of like long-term lifestyle diseases and things like that. That also really contributes to the total healthcare burden.
Hmm.
In addition, the common statistic that we pay more per pill than other countries pay for the same pill, in many cases. So there's a whole bunch of factors there, but yeah, everything else being equal, the demographics are a gigantic variable for why that's really hard to tackle. And so the challenge is that a lot of this is locked in any sort of like investable time horizon of 5 to 10 years. So when I talk about the nothing stops this train thesis, I kind of point out into the 2030s. Any more than that, the glass gets murky because
Yeah.
politics could look totally different. I mean, you could have a war, who knows what happens. But basically, in any sort of investable time horizon, that's the view. That's locked in pretty much.
Okay. So I want to try to connect, or maybe ask your thoughts about, is it worth it to try to connect your train, your runaway train of fiscal dominance with Mike Green's, concept of passive capital flows, and he calls it the giant mindless robot. Um, is there a connection between the two, even just in the fact that they're kind of these two things that are right now, they're just driving the action, and at some point they might not, and the world could be very different if they weren't. But we can kind of continue to project all right, if this continues the way that it's going, you know, then it's going to drive the action to kind of this general predictable point. So like in with you with the train, the further that train barrels, out of control down the track, we know the debt's going to get bigger. We know the deficits are going to get bigger. We know that the purchasing power of our currency is going to diminish as a function of that. And therefore, that informs your investing decisions, right? Okay, I probably want to be in hard assets and things that can't easily be inflated away, right? That type of thing. I probably don't want to be in bonds if inflation is going to be secularly higher because of all this. Um, the giant mindless robot, in some ways is kind of fed. I think as long as money is sloshing through the system, it probably help. And as long as there's deficit spending to keep people employed, that keeps the passive flow, the passive bid, well in place. Um, is there a connection between the two, and does it make sense to sort of think about them as somehow linked?
I view them as there being a connection, and it partially ties into fiscal, but I'd say even more it ties into the trade aspect.
Hmm.
So to recap for a second, like in Broken Money, I talked about this certain articles that there's a cost to being the global reserve currency. I mean, it goes back to the economist Triffin talking about this, of
Griffin's
course.
dilemma, right? Yeah, famously.
And it takes a couple different forms, but basically, the whole world needs dollars. The world uses dollars as its biggest ledger for international activities. So most currencies trade on interest rate differentials, current account balances, things like that. The dollar trades on those, but then it has this additional overlay of all this excess kind of inflexible demand. For using the dollar as a reserve asset, using it as a global funding currency. So if you lend money to an entity in another country, it'll often be in dollars.
And sorry,
Using
but this is what's referred to as the euro dollar market, right?
Yeah, exactly.
Hmm.
And then also the dollar is on 90% of foreign exchange trades. So, for example, if you want to get out of Egyptian pounds and into Korean won, that might not be a very liquid market between them. There's over 100 currencies, so the number of combinations is massive. Most of them are not very liquid, but most of them are liquid with the dollar. So you can always go one to the dollar and then dollar to the one you actually want to go to,
Yep.
and that represents by far the majority of trades. And it's also the unit of account for a lot of international contract pricing. So there's all this excess demand for dollars. And then the question is, how do they get all the dollars to do all that? And the answer is that we pour it out every year into the world through trade deficits. And it's not even necessarily an intentional decision because by all this excess demand for dollars, it basically boosts our import power. It kind of artificially increases our currency strength compared to what it would trade on based on trade, based on interest rate differentials. We have
Hmm.
this extra premium, so it boosts our import power and then it hurts our export competitiveness specifically for a lower margin stuff. So like manufacturing more so than say tech or healthcare. That's
Hmm.
like high enough margin that it can ignore that effect, whereas low margin stuff can't really do that. So we spew the dollars out into the rest of the world. Now, partially they float around and stay out there, but then the countries or the entities in the countries that have a really big persistent surplus, they want to do something with the dollars. And so in many cases, they reinvest those back into the US. So they go and they, for some markets, it's their real estate market. So in Canada or in Australia, Fords will buy their real estate market. In the US, it's primarily our equity market. Our equity market's it's the biggest, deepest, most liquid capital market in the world. Equities along with bonds. It's kind of the jewel of the world's capital markets.
Hmm.
And so all this kind of global dollar capital then gets reinvested in the US. And so when we are kind of running a persistent trade deficit of the world, we're getting more goods and services, but really instead of sending them dollars, we're sending them pieces of our businesses and to some extent pieces of our real estate, pieces of private equity, things like that. But especially our publicly traded equities, we're sending pieces to them because we're sending dollars and then they're buying a greater and greater share of our equities. And
Hmm.
so that's where there's a connection there because that's kind of a big dumb robot. That's just on autopilot. It's entrenched into kind of being the global reserve currency. And all this capital is every year is kind of flowing into the US. I mean, some of it is literally passive. Other ones might as well be. It's basically roughly market cap weighted. So it's just kind of piling into whatever the biggest, most liquid stocks are. Roughly speaking, the S&P 500 or the Nasdaq 100. And so that's kind of that structural flow. And then also because there's all that extra excess demand for dollars, it allows Washington to run these bigger deficits without immediate punishment. So, for example, Brazil got into a problem when they were running a similar deficit as a share of GDP as we were, but the difference is there's not like global entrenched demand for Brazilian currency. So any sort of emerging market, when they run something like our playbook, the market freaks out right away. Global capital pulls away, and they have to kind of adjust. Whereas the U.S., we're kind of given more rope to hang ourselves with,
Hmm.
and so our trade deficit and our fiscal deficit are somewhat tied at the hip, and they're somewhat tied to the global reserve status. And because that gigantic engine is just in place, that capital gets reinvested into our biggest companies, which is where you get, I would say, that connection to the passive flow and the big dumb robot. And where that could potentially be reversed is if you do policies that potentially reduce imports and you do policies that and or weaken the dollar, you could get a gradual reversal of some of those flows. You don't have to like pull a lot of capital out of the US, but if you just kind of
Hmm.
slow down the flows that are
Right.
going into it, or even just get to neutral, that can be a pretty significant effect on capital markets or on the currency itself.
Okay. Super useful. Thank you for connecting all those dots. And so let me try to take the beam a little bit more near term. Um, so, next 6 to 12 months, we are sitting here at a moment where stocks are more or less at all-time highs. I don't think they're on the day we're recording, but they're super close to it. Um, Actually, almost all assets have been kind of moving up in sort of almost a combined melt up over the past month or two here at this point. So correlations have sort of moved to one. People who care about valuations, which isn't everybody, but look at them and say, man, these are the most stretched metrics in many cases we've ever seen before on record. So you combine that with an economy that appears to be slowing now, a jobs market that no longer appears to be normalizing the way that Powell has been telling us all year, but now really appears to be weakening. Um, we might have this lag effect even in the next couple of quarters of the economic activity that should have happened but didn't kick into gear as well. So I guess first question is uh, recession risk, high, low, medium. What do you think?
I view it as medium in that time frame. And probably one of the biggest factors to watch there is AI Capex. There's somewhat of a kind of a flywheel there.
Hmm.
And it's of course one of those things where the big winners so far have been the chip makers, the data center makers, and whereas like a lot of the actual AI services are not profitable yet.
Yeah,
So
and
they're
sorry to
funded.
interrupt, but the analogy that's coming to my mind, it's like the old gold rush in California. It's like the guys selling the picks and shovels are making a ton, but we're not really sure too many people have found many gold nuggets yet.
Yeah, and now it's kind of like the pick and shovel makers are kind of also investing in those people to go out and keep doing what they're doing.
Yeah,
So there's
I
a
mean,
little,
they're almost giving them the capital to then continue to buy their products, which smells very much like the dot-com-y, questionable financing that was going on.
yeah. I think we could temporarily get over our skis there and have a pullback. It doesn't mean that technology is not real. It doesn't mean it's not going to change things substantially over the past
Yep.
over the next 5, 10 years. But it just means that you can get kind of like how building fiber optics got over its skis in the dot-com era.
Yeah.
And other things. So you could certainly, it doesn't mean the internet wasn't a big deal. It obviously was. But that's kind
It
of how
just
I,
took longer for the value to get created. No, absolutely. I think that
yeah.
analogy could be very true here. Yeah.
Yeah. So I think that's probably one of the key variables to watch in that time frame of 6 to 12 months. Because that's, if you kind of separate AI related CapEx to like everything else, it's like two different economies basically.
Yeah.
The same thing's generally true for valuations. Like, for example, if you look at US banks, many of them are very reasonable valuations. And they're profitable, they're doing fine. Whereas like, you look at Costco and it's trading at 50 times earnings.
Right.
And when you look at, index wide cyclically adjusted price to earnings ratios, so CAPE ratios, very high. Market cap to GDP, these are all very high. But it's very concentrated in the top 10, 20 names. And so, and of course, one of the downsides is if you do get a weaker stock market, you can get that wealth effect kicking in. So then wealthier investors are a little bit slower in their spending. because they're a little bit spooked by the economy, by the market, and then you
Right.
can get kind of a self-fulfilling prophecy. So instead of the stock market reflecting what's happening in the economy, sometimes the economy reflects what happens in the stock market once you
Right.
become this financialized. Um, but the caveat I would say is that recessions look different under fiscal dominance. We're already
Hmm.
pre-stimulating by 6 to 7% of GDP fiscal deficits per year.
Yep.
And so in some ways you get more of like an emerging market light recession, which is another way of putting it is so back in 2022, we skipped having an Enber defined recession, even though the misery index, so the combination of unemployment and inflation, spiked to recession levels, mostly because of the
Hmm.
inflation component. Consumer confidence absolutely collapsed to recession levels. PMIs were sub 50. If you look at the Conference Board leading indicator, it's been flashing recession for the majority of the past 3 years. It kind
Right.
of briefly got out, then went back down. Um, PMIs, I think I already mentioned those. Those are super low. That's one of the factors. So a lot of these things are flashing sometimes red, sometimes yellow warning signs for recession. But the two things that have been supporting it is one, the labor market hasn't cracked fully, and two, partially fueling that is those deficits. So if you have real estate's slow and commercial real estate's basically depression, manufacturing's stagnant, but you keep pouring money out to Social Security, Medicare, defense, interest expense, all these other things, and then that trickles into the rest of the economy through employees, contractors, contracts, all that spending just kind of diffusing out there.
Hmm.
It's this big lift, and you risk getting more stagflationary type of environment where you don't get some big disinflationary implosion in the way you might get, say, a global financial crisis, something like that, but you get more of a malaise where inflation's
Yep.
still above target, and yet also cracks, early cracks in the labor market and things like that.
In fiscal dominance, when you have those, let's call them shallower recessions, but they're these periods of malaise. I don't know, but do you get more of them? So they're not, it's not like a big bust like 2008 or 2001, but it's more you dip into it, maybe you get out a little bit, you dip back in again, or is there no
You
pattern
could,
like
you
that?
you could. I mean, that's where the Conference Board leading indicators kind of pointing that you kind of are in mild recession, a little bit out of mild recession, then back in mild recession.
Hmm.
That could be common. It depends on details. An example I can point to, we were talking before before we recorded that about Egypt. Uh, a lot of viewers might know I spend time in Egypt, and for example, over the past 10 years, if you look at say per capita energy consumption, it's been flat to down. And if you look at, let's say over the past 5 years, the labor hours it takes to buy a car there, especially the same model of car, has gone up. So people have to
Hmm.
work more hours to buy, an imported computer, an imported Volkswagen, whatever the case may be. Um, and so the instead of kind of being an unemployment spike and then back to growth and unemployment spike, that emerging market style recession is kind of everyone's vaguely poorer, or at least a lot of people are vaguely poorer, and they're not 100% sure why. A lot of it's the currency itself. Um, a lot of it's kind of like weaker productivity going on. And in their case, productivity partially saved them in the sense that that was also during the time where Chinese vehicle exports ramped up dramatically. They became the biggest auto exporter. So
Yep.
they're now producing decent quality cars for cheap. So that is like a substitute that Egyptians can and do switch to. But if you look at like the same car, like a Volkswagen or something, that's where the recession kind of really shows up. And so I think that's a more extreme example. I mean, they were dealing with a official like 38% inflation at one point in recent years. Um, but you get kind of the milder version of that, which is everyone's kind of saying something doesn't feel right, or things aren't booming, even if they're not exactly collapsing. They're just
Hmm.
kind of rolling along and being partially hidden by 7% of GDP deficits and ongoing debasement.
Right. And Lynn, I'm going to guess you probably hear from a lot of the same people I do who are contacting me and saying, that's how I feel right now, right? I'm being told, look, GDP is over 3%, stock market it's at all-time highs, unemployment's at, near historic lows. But personally, either I feel like I'm in a recession or I just feel like I'm falling increasingly behind. Is that a feature of fiscal dominance? Not a bug?
It's a common feature. So fiscal dominance can take different forms. For example, the last time the US was in it was in that World War II era. And a lot of the deficits were actually poured into the bottom half of the economy. It was poured into soldiers, it was poured into manufacturers, it was poured into the soldiers coming back and
Yeah.
being subsidized to buy houses. It wasn't really pouring into the top as much. And it was combined with like pretty draconian tax rates as well.
Right.
So basically bondholders and rich folks got kind of squeezed in various ways. Obviously handful if you're on the right side of some of those deficits you did well, but for the most part, it kind of pulled out of the top and cycled into the bottom through inflation. Whereas at the current time, it's getting sucked at in multiple parts and kind of put in sometimes to the top, sometimes to the very bottom. But basically, if someone is not receiving a ton of government aid or anything, so maybe they're working class or middle class or in that kind of ballpark and younger, they're not really on the receiving side of deficits in many cases. They're not receiving Social Security, they're not receiving Medicare. If they don't work for defense, they're not receiving that. So they're kind of on their own, but they're on the wrong side of tight monetary policy. So mortgage rates and mortgage expenses are super high. They're also suffering the inflation from the fact that those deficits are pouring into others. So if you give deficits to, say, Social
Right.
Security recipients, they go out and spend it. It keeps prices elevated what they otherwise would be. And if you're not the receiving side of the deficits, your egg prices or whatever is going, your grocery prices are going
Right.
up,
You
but
eat
you're
the cost of living and you have no relief on the other side of the ledger. Yeah.
exactly. So where you are in this matters a lot. So um, it, that's the problem. It's very heterogeneous. It is a two-speed economy. It's not quite as simple as rich and poor or old and young, but there are certain directions there that are
Yeah.
generally happening, and that's where you get a lot of that feeling like, well, the numbers look fine, but I don't feel fine. And actually, the same thing happens in Egypt, which is officially the GDP per capita is up, but then it's like, if energy per capita is down and it's a developing country, so energy is not high to begin with. It's not
Yeah.
like, in America, we have so much extra energy that our energy per capita is not necessarily telling a lot because, mildly more efficient appliances or, things like that can tweak things, or shifting our manufacturing overseas or something. Whereas Egypt's got like 1/8 of the energy consumption that we have. So the fact that their energy consumption's flat to down, brownout rates are going up. So you know, things just like the power grid going out during parts of the day in the summer in the Saharan desert. Um, that's what they feel, and then they see the numbers that say, well, but the numbers say it's up, and we again we have a milder effect, I think, of that in the U.S., which is there are pockets that are doing well, but the people should believe their eyes to some extent.
Yeah. No, I think that that's sort of the increasing risk we run here that I'll ask you more about in just a moment here in terms of purchasing power decline. But just one other thing to mention. I mean, I agree right now that there's stimulus at different levels, but it's hard not to argue that it is highly correlated with those who own assets,
Yeah,
and also highly correlated with age. And that's just because age is correlated with asset
yeah,
generation or asset accumulation. Um, and I think that is an output of fiscal discipline, which is that it artificially props up asset prices. But disabuse me if that's wrong. But if it's not, then yeah, I mean, it explains a lot. I think I just saw the latest stats that, what is it? I think it's less than the top 10%, but I'll say the top 10%. They control, I think now over 50% of all consumer spending. And if you look at the bottom 60%, I mean, I'm not even sure it's 15% of spending. Like it's almost like the bottom 60% could just stop spending altogether and it wouldn't really matter that much. Which shows the oversized advantage that the people who are benefiting from this process get.
yeah. As you point out, there are a lot of correlates there. So age and asset ownership are highly correlated. Now, obviously, there's
Yeah.
very different things can happen over the course of a lifetime. But and then also, of course, the demographics and Medicare and Social Security are obviously age dependent
Yeah.
entitlements that
Yeah,
people
actually,
paid into.
most of the things that are on that train, those four cars, benefit the old, right? If you're
Yes,
young, you don't
yes,
get Medicare, you don't get veteran benefits. Well, I guess you get veteran benefits, but you have to have had the time to serve, right?
yeah,
You don't get Social Security.
yeah.
So, to your point,
Yeah, and another way of looking at it is the number it used to be with Social Security, the number of people paying into it per retiree, so worker to retiree,
Was
might
high.
be yeah, it was like five people paying for every one, and then it drifts down to three and goes under three, for
Yeah, it
example.
was
And it
actually
just
when it started. I can't remember
super
exactly, but it
high,
was a
very
lot.
high.
I mean, it was in the
Yeah.
double digits. Yeah.
Yeah, very high. Um, and so that's to some extent what people feel. And of course, I want to be careful to say that there are, for example, seniors that are not wealthy, for any number of reasons, and they wouldn't want to be lumped in with, well, like the seniors are getting all the goodies because they're saying, well, I'm not getting, I'm barely getting by on Social Security, someone could say, and that's absolutely true. So it's not as simple as, of course, breaking it down exactly by age or asset ownership. Someone could own a lot of assets, but then their business is being pounded by tariffs, for example, and they're saying, "Well, I'm not in the booming camp at the moment either." So
Hmm.
there are spots of exceptions everywhere. But yeah, the general rule with loose fiscal that's geared toward age demographics combined with tight monetary policy is if you're looking to buy a house and you don't have assets yet, you're having a rough go. And if you work in an area where you're not really for any number of reasons on the receiving side of deficits, whereas if you've already got your assets, if you either don't have any debt attached to it or you've got a fixed rate debt back when it was cheap, and you're receiving Social Security and or Medicare, any number of those things, you're on the right side of fiscal dominance, and that's where you get that two-speed economy.
Okay. Which, kind of folks, what we're underlying here is that, there's a lot going on here. So you really need to understand the nature of the forces in play. And that's what Lynn's book and her ongoing writings do such a great job of keeping us informed of. And then figuring out, okay, how do I actively invest in this type of environment? So, okay, one or two more questions for you, Lynn, before I start having to land the plane here. Um, I just love to get your thoughts on this. So another stimulus that has been going to asset owners and largely older asset owners that like to own this asset class has been the T-bill and chill trade, right? And finally, and I'm not, I don't begrudge the fact that there has been a T-bill and chill trade because for much of the ZERP era, you had seniors, their problem was is they had worked their whole lives and saved to live off
Yeah.
a fixed income, and then all of a sudden that fixed income pretty much went away. Um, so anyways, folks have been very happy to get a safe 4-5% return over the past couple of years. Presumably, there's now a timer on that, an end timer on that, as the Fed resumes a rate hiking regime, and it seems that the administration looks to replace Powell and maybe even a few more people on the FOMC with more dovish people. Um, so that 4 to 5% return on T-bills is a monthly injection. Well, I shouldn't say monthly, but it's a regular injection into the portfolios of the people that own them, and it's pretty substantial.
Yeah.
What impact, if any, or I guess what's the net benefit, do you think, of the T-bill and chill trade going away? Yes, these people will have less money to spend, but our national interest bill will go down.
Yeah, I think that it'll be exactly what you said. And that's part of fiscal dominance. That's a key part of the thesis, which is most of the Fed's tools, which is basically balance sheet size and interest rates, that's mostly around either encouraging more bank lending, accelerating bank lending, or slowing down bank lending.
Mhm.
Whereas when you already, and that works when you say, when Volcker jacked up rates, it helped because most of the money creation was from bank lending. Federal debt was only 35% of GDP. So while raising rates did to some extent blow out the deficits, it slowed down bank lending even more, and therefore it did the intended effect that Volcker had. The problem in the current era is that when federal debts are over 100% of GDP, and the majority of fiscal spending is bigger than net new bank loan creation. So bank lending is already somewhat subdued, holding rates high, the problem is that you blow out deficits by literally a bigger dollar figure than you slow down bank lending. And as you point out, a lot of that bigger deficits goes to people's money markets, goes to people's portfolios, and it's spendable money into the economy.
Mhm.
And of course they benefit, but it's stimulus. And to some if it's older, wealthier people, then you're kind of exasperating that two-speed economy. You're basically stimulating the people that are already doing fine, and that actually gives them more spending power that then hurts people at the grocery store that aren't receiving that. That's the complicating factor. So a lot of these things have winners and losers. Generally speaking, we should expect mildly lower interest rates going forward with a more dovish Fed and cracks in the labor market, which takes the air out of the T-bill and chill trade. Um, but that also, potentially weakens the dollar a little bit, brings back a little bit of inflationary pressure, or at least sustains existing inflationary pressure. It doesn't necessarily affect longer term rates. So mortgage, like house buyers might not get a ton of relief. They might get some, but they might not get a ton. If the market perceives, and this is where where longer rates will very much matter, because if the market perceives that the Fed is doing something rational, so if they say, okay, this labor market cracks, it makes sense to cut rates, then probably mortgage rates and long duration treasury rates will also stay somewhat subdued. Whereas if the market perceives it as political, saying that, well, stock market's at all-time high, gold's near all-time high, Bitcoin's somewhat near all-time high, um, things are running hot still, kind of, and you're cutting rates, then maybe I'm going to sell off the long end. So it depends what ratio the market perceives it as a political kind of necessity versus just kind of Spock-like decisions on economic and where you're going to trim the numbers. But basically, that we should expect a mild reduction in that spending going toward seniors, but then still all the other variables are still very big.
So very big. Okay. All right. There's one last question I want to get to and asking you. It's a little bit different from everything we've been talking about. Before I get to that, Lynn, just to kind of get to the like, all right, the so what of it all. As you look ahead next 6 months or so, and a lot of what you do is analyze and advise your clientele, what assets look well prepared for the next, for the road ahead and which ones don't. Are there any kind of clear trends right now that you're focused on?
So apart from hard assets like gold and Bitcoin, there's certain energy pipelines I like. One of the somewhat not very popular trades that I like is actually certain U.S. financials. And part of that is because there are many, medium-sized banks that I think are in good financial shape. And because of their fiscal dominance, I don't expect a recession to seriously result in impairment to their balance sheet from loans. Of course, around the margins, any sort of weakened economy, you're going to get an uptick in loan issues, but I
Hmm.
think that's already well priced in terms of their how they're managing risk and in terms of how investors are pricing their stock. And so I actually think many medium-sized banks are worth looking into. And I've also been fairly bullish on emerging markets. Now, eventually, I think that trade will get somewhat overdone. I don't think we're there yet. So I've been, somewhat bullish on Brazil, for example, and Brazilian banks and just Brazilian equities broadly, especially inclusive of dividends. So sometimes you look at these stocks or ETFs, and the stocks is kind of, it could be grinding sideways, it could be grinding up, but then it's often paying pretty big dividends depending on which one you're looking at. So on a total return basis, that's interesting. And to some extent, when you have a fiscally dominant environment, um, it's not just hard money. It's kind of some of these value equities that are not value traps. So things that are somewhat on the receiving side of the deficits. So banks are on the receiving side of interest expense as well. Depending on how they manage their loan book and their security book. I think we've gotten past the worst of their issues back in 2022, 2023. And so that's an area that I'm constructive on a name by name basis.
Okay, and obviously for name by name basis and stuff, folks can subscribe to your
Yeah.
service and they can hear your particular thoughts there. With the energy pipelines, are those mostly like the midstream companies
Yeah, I think
that we
some
hear
of those
about?
are reasonably priced, and generally there's a phenomenon where the limited partnerships, like the master limited partnerships, are better priced than the C corps. And there's a bunch of reasons for that. The C corps are easier to invest in tax-wise by foreign investors, so they tend to prop up the valuations.
Hmm.
Whereas if you're an American and you're looking to buy those long term, you can generally get a better deal by going into some of the high quality MLPs. You'll basically get a similar quality company, but generally a somewhat higher yield because there's a little bit lower starting valuation. And so all else being equal, I like certain MLPs for longer term investors, five plus year income play.
Okay. And as I understand it, so correct me if I'm wrong, in an era of fiscal dominance, bonds aren't a very good bet because you basically have inflation working against you. As you look out to the next 6 months, and we talked a little bit about, I think you gave the risk of recession as moderate. Um, uh, do you still see bonds as something you don't want to touch, or is there a potential that if we have disinflation in a slowing economy, and maybe even a little bit of a safety trade, as well as the Fed bringing, rates down or whatnot, could there be a near-term trend to ride in the bond market?
So bonds are certainly tradable. It's not something I choose to focus on because I think the upside's somewhat capped. My general view, so I've been a bond bear since 2019. I think the worst of the bond market is likely over. So I don't think we're gonna have another 5 years that were as bad as 2019 to 2024. Um, and I think we're more in the slow motion train wreck part, which is bond yields are starting from a higher yield position than they were before. Um, there's certain periods where the equity market could get overvalued and bonds could outperform for 6 months, 12 months, sometimes more, even if the returns aren't great from, a 4% yield standpoint. Um, and so I do think that whether it's tips, especially for it- retirees or other people that need kind of low volatility portfolios, I do think that bonds at these levels can play a role. Um, it just kind of understood that they're volatility reducers that are kind of treading water. They're not really adding, that yield is mostly illusionary. It's just kind of offsetting debasement and not even fully doing that, especially when taxes are considered. So it's not one of the worst things out there on a kind of intermediate term basis. But I do think that over the next 5 plus years, that will continue to be one of the losing areas um, as you have ongoing fiscal dominance.
Okay. And given all the valuation uh, extremes that I mentioned a little while ago, the fact that the market does seem to be quite euphoric at the moment. Um, do you have any thoughts on, hey, this is a time to have oversized amount of cash in your portfolio? If you still be long, but just have some buffer there, given how extended things seem to be, or are you not that worried?
So I hold a decent amount of T-bills in my portfolio. Still a fairly small position. It'd be larger if I was, say, retirement years. Um, and the other defense, in addition to just cash, is to own some of the things that are not expensive. And so kind of the way I've structured my equity positions is just, avoid as much as I can some of the bubble names. Stay in names I view as kind of fairly valued but still growing and attractive on a total return basis. And there are certain years where that underperforms because the bubble stocks do really well, but then in pullback years that strategy generally holds up pretty well. So for example, 2022, which is really bad for like the mega
Yeah.
cap stocks in many
The Kathy Wood
cases.
stocks were down 80%. Yeah.
Yeah, they were crushed. The Mag 7 was crushed less. They at least recovered. The ARC style ones didn't fully recover in many cases. Whereas like healthcare was up, energy was great. Um, kind of other sort of value adjacent stuff was it depended. It was mixed, but it was like not as bad. So there are certain times where that strategy pays off, certain times it doesn't. I do a little bit mix of both. So that's another thing to consider. It's not just cash. It's also what parts of the market am I in? Or also another way of putting it is people often assume that if the US market does poorly, it means emerging markets are going to do worse. When you have dollar weakness and fiscal dominance, that's not necessarily the case. I mean, for example, this year, if you ask people, okay, the US is going to do a US first tariff blitz, is our US stocks or emerging market stocks outperforming year to date? Most people would say, well, emerging markets are probably hurt. I mean, they're the ones supposedly being tariffed, but they're doing pretty good this year. Um, and so there are pockets you can go to that are not necessarily cash, but that are kind of beating to their own drum.
Hmm.
Uh, not to say that cash isn't also useful, but it's just by having all these different segments like cash, gold, Bitcoin, emerging market equities, value equities, some growth equities too, I like. But if you have that kind of mix, any given pullback ends up being less extreme to you in most cases.
Sure. And that's, folks, the benefit of diversification in general, but obviously Lynn's taking it in a way that adds additional risk management in there. All right, Lynn. Well, look, thanks. This has been wonderful. Again, folks, I specifically didn't ask Lynn about Bitcoin and anything else crypto related because that's what we're going to do at the conference. Lynn, I'm going to wrap this up in just a minute with some housekeeping. But before I do, let me ask you this question. I noted on your X feed the other day that you posted a famous Norman Rockwell portrait that we all know, and said or asked, "Hey, does anyone know the name of this portrait?" Because it has a name, and the title was "Freedom of Speech." We've had a lot happen in light of recent events around free speech that's caused us to reflect, I think, not even just as a nation, I think as a global society, on its role and its importance. I wanted to give you a chance to just sort of share your thoughts, if any, around what you've been mulling on free speech, given again recent events.
Yeah, I think it's important to just reiterate, especially as Americans. I mean, free speech is something that is kind of structural to how I think the country's been so successful. Um, and speech can be taken away in multiple ways. It can be taken away from violence. It can be taken away from government oppression. Some people, of course, mix it up between private actions. So freedom of speech doesn't necessarily mean freedom or guarantee of a platform. So
Hmm.
private entities could certainly take action, or there could be consequences, for certain types of speech that is either unpopular or wrong or whatever the case may be. But that's very different than obviously violence towards speech or government attempts to suppress speech. One of the areas that I've been interested in, it's not really Bitcoin or crypto, but it's kind of adjacent, is decentralized social media, for example. Back in the prior administration and before, I was really interested in alternatives to these big centralized platforms that are kind of unilaterally censorable. So having decentralized ways to go around, as well as just a general culture that uh, you know uh, is willing to disagree with people, but that will defend their right to speak. Again, not necessarily to have a platform, but that they can say what they want, and if they can build a platform, then they get it, and if they can't, then they don't. So, yeah, whenever we go through these times, I think it's important to kind of go back to some of our fundamental values and some of the things that have gotten us this far.
All right. Well, I completely agree, and I haven't talked about it all that much, but have talked about it, I think, enough in recent weeks to say that hopefully, this is one of those values that we can all agree on, right? As divided as this nation is, free speech is the bedrock of Western society, and there's a reason that's the First Amendment here in the States, and that in no circumstances is violence an acceptable response to someone expressing their freedom of speech. So it seems like you're all right there. For folks that are
Yeah.
maybe perhaps interested in learning a little bit more about decentralized social media, is there any direction you could point them in to learn more?
There's a protocol called Noster. Notes and other stuff transferred by relays. Like primal.net is one of the clients. But it's kind of like how when we use email, all of our different email clients can talk to each other because they use an underlying communication protocol, simple mail transfer protocol, and certain others. Whereas in social media, we're in these kind of more isolated ecosystems. Like, if you're on Twitter X, you can't talk to people on Facebook. Whereas
Hmm.
if you're on Gmail, you can talk to people on Yahoo or Proton.
Right. Great
Uh,
analogy.
and and so Nostr is kind of like that, where you have a open source substrate, an open source communication standard, a language, and then people can build different clients. And you could have something that looks like a Twitter clone, you get something that looks like an Instagram clone, you can have entirely your own thing, and they have their own aesthetics and ecosystems and algorithm policies, whatever the case may be. It's open source, you can build it. But then they communicate in a similar way that email clients communicate. So I did generally found that interesting. And last year, 2024, I interviewed Jack Dorsey at the Oslo Freedom Forum
Hmm.
because we were talking about that. It was so that's an area that he's been focusing on too. And for people that know his history, he had challenges trying to figure out how to run a centralized platform in a time of heat around that
Hmm.
subject. And then also he tried Blue Sky, which he tried to kind of take part of the substrate and separate it from Twitter. And the problem was that kind of got captured as well. So now Blue Sky is basically
Yeah.
kind of like how Twitter X is sort of right-leaning. Blue Sky is kind of Twitter for the left. It
Left,
was
right.
not really.
Did Jack Dorsey, did he develop Blue Sky?
It spun out of stuff he kind of helped spearhead it.
Okay.
And he was initially on its board. And when that kind of didn't, I don't want to speak for him, but there are articles and quotes he's talked about. But basically, his latest focus is on Nostr, which is kind of more open source and kind of more, kind of closer to I think what he was intending, you could say. But basically, it's kind of the idea of ecosystems can kind of manage themselves, but you get a lot of power if those ecosystems can also talk to other ecosystems in an open source way so that, you can still filter spam and, extreme hate or whatever the case you're trying to do. With different platforms can have different policies, but then there is that underlying thing so that if something gets blocked, you kind of control your own key. Like you control your own identity that can kind of rotate to different ecosystems, kind of like how imagine if you could go to a different webmail provider but still have your emails, for example.
Right,
That's
right.
kind of how that
And it
works.
makes it harder for a central authority to
Yeah,
deplatform you, if you will.
ex exactly.
Yeah. Okay. No, fascinating. All right, Lynn. Well, look, most important question of the interview. Besides attending the conference in a couple of weeks, where can people go to follow you and your work?
People can check out lindalden.com or they can check out Broken Money on Amazon or elsewhere. Thank you.
Okay. So, Broken Money is basically sold anywhere books are sold.
Yep.
All right. Well, in wrapping up here, folks, please join me in thanking Lynn for giving us so much time and being so liberal with her insights here by hitting that like button and then clicking on the subscribe button below, as well as clicking that little bell icon right next to it. Again, a reminder, if you would like to hear Lynn opine specifically on her thoughts on Bitcoin and what's going on in crypto right now, and there is a lot going on right now, and it's an asset that many of you in this audience tell me you don't fully understand and want to get the insights of a good expert. That's why I invited Lynn to come talk at the conference. Then go get your ticket right now if you haven't already got it for Thoughtful Money's Fall Online Conference on Saturday, October 18th. To do that, you can just go to thoughtfulmoney.com/conference. And if you go now, you can still lock in the early bird price discount. It's the lowest price that we're offering. I want as many people as possible to get that lowest price. And if you are a premium subscriber to our Substack, make sure you check your email inbox for the emails I've sent you that have the code, the discount code you can use to get an additional $50 off of that lowest price early bird discount. And lastly, too, if you can't watch live on October 18th, don't worry. Everybody who registers will get sent replay videos of the entire event, all the presentations, all the live Q&A. Lastly, if you would like to get some help from a professional financial advisor about how to position your portfolio and your financial wealth for this era of fiscal dominance, and particularly for maybe the next 6 months ahead that I talked about right there with Lynn, then consider talking to one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule one of those consultations, just go to thoughtfulmoney.com. Fill out the short form there, only takes you a couple seconds. These consultations are totally free. There's no commitments involved. It's just a free service these firms offer to be as helpful to as many people as possible. And with that said, Lynn, thank you so much. It is always such a joy having you on the program. Really is a privilege. Really looking forward to talking to you at the conference. But again, thanks so much.
Thank you.
All right, and everybody else, thanks so much for watching.
In the bust, most assets are going to go down other than treasuries. But so gold will correct. If 4,000 were the high, and it may not be, could just as easily be 4,500, but if 4,000 is a high, you could be back to 3,000 or below in the bust. People want a target in the bust. I go, we don't even know what the high is on the way up. So, but it'll get hit by, 30% or more probably. Silver, if my target on silver is 75, if we correct from 75, that is more volatile, so that could go down, back into the below 30 or back into the 20s. So they're not going to be straight lines. In both cases, I think this is important. In both cases, in the post-bust era, which is 2027 and beyond, I believe you'll see gold probably in the early 2030s and silver same time frame. Gold to 20,000 and silver to 500. So
the outlook suggests that during a coming bust, nearly all assets except treasuries could fall sharply. If gold peaks around $4,000 to $4,500, it could correct by 30% or more, potentially dropping back near $3,000. But Goldman Sachs says gold could hit $5,000 under scenarios like political threats to Fed independence. Meanwhile, silver, being more volatile, might fall even harder. If it reaches $75, a correction could send it back below $30. These moves won't be in straight lines, but in the long run, especially from 2027 onward, the forecast is extremely bullish. Gold could reach $20,000 and silver around $500 by the early 2030s. David Hunter, a precious metal expert, points out that gold recently broke out of its consolidation range around $3,300 to $3,400, pushing to new highs, with targets now raised to $4,000 and possibly higher. Goldman Sachs warns that gold's price could increase dramatically if the Trump administration's attack on the independence of the U.S. Federal Reserve is successful. They say that would trigger a flight from traditional safe havens, assets people run to when markets get shaky, traditionally, the U.S. dollar. Forecast already predicts gold reaching $3,700 by the end of 2025 and $4,000 by mid-2026. The result of their expectation that central banks will continue their current gold buying spree. On the other hand, silver has been even stronger, up nearly 50% since April compared to gold's 21%. David mentions key drivers include a weaker dollar, falling interest rates, geopolitical tensions, and heavy central bank buying, all reinforced by strong momentum now attracting institutions. The dollar, down from 110 to 97, could drop further toward 82 in steep steps. With the Fed just beginning a rate-cutting cycle that could bring rates near zero over the next 18 months, both gold and silver still have significant room to run despite cautious sentiment in markets. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article.
Absolutely, and I do say gold was in a consolidation from basically April till recently, and it broke out, from 3,300, 3,400, broke out here, and we're at new highs again. I raised my target to 4,000 last year, or not last year, I think a couple letters ago, and I'm not going to be surprised if that proves to be low, more conservative. So I'm very bullish gold here. I'm even more bullish silver. Silver's had a great run. It's up. I just did the numbers yesterday. From April to now, gold is up 21%, I think, and silver's up 49%. So it's quietly, people haven't really noticed, but it's quietly outperforming gold as it does in a bull market. So I think silver has a long ways to go. Gold probably has a good ways to go too. So I think the weaker dollar is certainly part of that story. Lower interest rates is certainly part of that story. Global unrest and global uncertainty is certainly part of that story. And the central banks around the world gobbling up gold is certainly a piece of it too. So, and then the final piece, which people always underestimate, is the power of the momentum. It's all of a sudden the institutions are starting to notice gold, even though it's been running for years. Because it's got that momentum now, they're starting to say, hey, we have to have a piece of gold in our portfolios. Not at all. I mean, the dollar's fallen from, basically 110 to 97 in a matter of a year, probably, or less. And I think it's my target is 82. That's far below here. It'll happen in some pretty steep steps. So the first step down in the mid 90s, and then you consolidated here. I think the next step down takes you down through 90, and then the third step down to 82. So I'm not surprised at all. You have to go through consolidations when you have such a big decline. It then goes the other way for a little while, You have to convince some of the people that were jumping on the bandwagon, but not with conviction, that whoops, this thing's going the other way. So I think we've just pretty much gone through that consolidation, and now we're beginning the next leg down, and I think it could happen pretty fast. Well, think about that. I think that tells you the sentiment that's on the street. Everybody's got including yourself just there, everybody's got a foot out the door saying, when do I exit, right? And so what we've had here, we're just beginning an easing cycle. If the Fed is truly just beginning to cut, and that there's going to be many, many cuts between now and the end of next year, where you could see the Fed fund rate go from, 4.25 here down to even zero. They don't know that yet. They have no idea that's what's coming. But if in the next 18 months, that's what you're looking at, and you're early on in that, and you're at a point where it doesn't look like the economy's falling out of bed, gold's got a ways to run. Silver's got a ways to run. The stock market's got a ways to run. And yet everybody's getting nervous here rather than bullish.
A few years ago, David called for a major market melt-up, and has steadily raised his targets as conditions improved. His S&P 500 target has climbed from 6,000 to 8,700, with Nasdaq at 30,000 and Dow at 60,000. He views this as the tail end of a long bull cycle that began in 1982, likely topping out soon, but still with strong upside left. Despite a slowing economy, falling interest rates and steady earnings are fueling gains. Interestingly, retail investors have stayed confident and bought dips, while institutions were more cautious and even bearish, only now starting to turn more aggressive as they see the market's momentum. Let's look back at the interview.
Probably 3 or 4 years ago, because I was calling for this melt up, and I get accused of raising my targets constantly. I go, that's what you do. As the evidence proves it's got more, there's more things saying it should go higher, you raise your target. So, I started out at 6,000, or even before that at 4,000, but I've raised it to, 7,000 and 7,500 and 8,000, now 8,700 on the S&P. And same thing, I've raised my gold target a few times. But it's the case that this thing is a big historic bull market. You just gotta stay with it. I'm sorry, I lost my train of thought of what you would. Oh, you were talking about the VIX. Several years ago, I said the VIX could go to 10, and that was when it was in the 20s. I said if we've got, and that was when I thought the market might go to 4,800 or 5,000. I still would say that the low on the VIX, I think, is down just below 10. I think that's probably where we're headed again. So everybody gets worried when it gets down at 14, 15. I go, it can keep going, and there's no magic at 10. If it wants to go lower, it's really, it's a trading vehicle. There are times when it the market goes through a swoon and it bounces back up over 30 and maybe over 50. But other than that, I don't use it at all to say this is the top in the market, because it can go lower. We are, as I've been saying for a long time, I think we are late in a long cycle, a bull market cycle that started back in 1982. So this is the 43rd year as of August of a bull market cycle that I think is coming to an end. I expect to see, we probably could top out by the end of this year or sooner. But we've got, I raised targets back in April when we had Liberation Day and everybody got bearish. I raised my target to 8,000 on the S&P. From there, in my July investment letter, I raised my target to 8,700 on the S&P, 30,000 on the NASDAQ, 60,000 on the Dow, and the Russell 3,400. So I obviously think there's still a lot to go here, even though I think it's going to happen pretty fast. It is late in the game. We've had a long cycle. The economy is slowing. We may, in fact, already be in recession, but at this point, the evidence is not building to something that says I'm calling for a global bust next year, as you know. But the evidence right now allows most of most investors to see this as a soft landing, and earnings are still intact. So basically, you've got the best of both worlds: slowing economy, what I think are going to be declining interest rates, and earnings still growing. And that's music to the ears of Wall Street. That will get all the skepticism that's built up on Wall Street. They've fought this market since 2022, all the way up. You're starting to see them begin to say, "Hey, I gotta get more aggressive because this thing has legs." People, it's not that institutions go all in or all out. They're probably not very much in cash, but they're more defensively positioned. They have been skeptical towards the market. You're right. The retail investor, surprisingly, when we had that swoon back in April, they stayed in the market pretty much, and said this is a buying opportunity. It was the institutions that jumped on the bear market bandwagon and said, "Oh, we're going lower. We're going a lot lower." Strategists across Wall Street were lowering numbers and talking about 4,000 or 3,000 on the S&P. And it was surprising to see the retail investor stay basically on board and bought down there. Like I said, at the very bottom of the sell-off in April, I raised my targets while everybody else was lowering their targets. So, kudos to the retail investor that they this time were the smart money, and it was the institutions that weren't so smart.
Both gold and silver are showing powerful momentum, supported by central bank demand, a weakening dollar, and shifting global policies. While sharp corrections are possible if gold peaks around $4,000 to $4,500 and silver near $75, the long-term outlook remains extremely bullish, with forecasts of historic highs by the early 2030s. At the same time, equities may still have room to climb, even late in the cycle, as falling interest rates and resilient earnings continue to provide fuel. If a sharp correction does occur, would it present a buying opportunity for long-term investors or a warning sign of deeper risks? How much influence will central bank gold buying have in preventing deeper pullbacks in the years ahead? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
The point is, we're seeing lots of silver that is being accumulated by the central banks. That's $2,225,790,000 worth of silver has come into COMEX. In the first week or so of the month, Russia, China, Saudi Arabia. Let's not forget about India, who's bought somewhere between 600 and 800 million ounces over the last 5 years. That's more than is on the COMEX and the LBMA combined. Most of the public has zero idea that there is a massive drive going on for gold and for silver. First week of September, you're seeing nearly $4 billion worth of metal stand for delivery. But this is what we've seen every single month. Now, we've always been an importer of silver, not always been, in fact, never, to my knowledge, been a net importer of gold. Both of them together signal a bigger move, a bigger trend.
Central banks are quietly stockpiling huge amounts of silver, with Russia, China, Saudi Arabia, and India leading the charge. Saudi Arabia has made small but notable purchases of silver via ETFs recently, which may signal a shift in behavior. China has bought 21 metric tons of gold so far this year, 2025. It's part of their strategy to diversify away from the dollar and align reserve assets with their global status. The notion that BRICS and other developing nations are considering silver more seriously due to its dual uses is being more widely reported. India alone has accumulated 600 to 800 million ounces in the last 5 years, more than what COMEX and LBMA hold combined. The US, traditionally an importer of silver but never of gold, is now importing both, a clear sign of a much larger global trend toward physical accumulation of precious metals. Andy, the president and CEO of Miles Franklin Precious Metals, highlights that what makes today's market different is the sheer scale of physical gold and silver being accumulated, not just by investors but by central banks, with Russia allocating it in its 2025 to 2027 budget and Saudi Arabia making ETF purchases. Capex deliveries of gold and silver remain historically high, signaling strong demand for physical metal, while a weaker US dollar is further boosting gold and drawing silver into reserve diversification strategies. Analysts like Mike Maloney see silver poised for significant upside in a potential monetary reset, though claims of India's massive silver accumulation and extreme delivery spikes remain unverified. Experts also warn that paper metals may not provide true protection in a crisis, driving the push toward physical holdings. Andy believes the public, meanwhile, remains largely unaware of this massive shift toward physical metals. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, I think that what differentiates this market from anything I've ever seen, Ivan, and I've been doing this now for almost 36 years, is the amount of physical demand that is being accumulated. Now, we've talked at length about the central banks that have been buying gold. We're seeing action with the central banks buying silver. Now, of course, it started with Russia saying they were going to add it to their stockpile. First time I've ever seen a government do that. And then it mitigated moved towards China. Talking to guys like Sean Kuhn from Dolly Varden, he says, look, Andy, the Chinese, who are the second largest producer in the world, they told David Morgan they're the first, by the way, but needless to say, they're massive producers. Sean says they're flying all around Latin America, in particular places like Peru, even all the way up to Mexico, and pulling metal out of the ground before it's even called silver. They're buying doré, they're buying concentrate. They're paying double what the West will do to disintermediate the whole market, sending it back to China for refining. So you have the first or second largest producer in the world finds it significant enough to fly around the world and buy doré and concentrate right out of the ground from the miners, directly from the miners, and then sending it back to do so under the cover of anonymity, so to speak. No one really knows how much they're buying or what they're getting, but Sean can validate that is indeed what is happening. You look at the Central Bank of Saudi Arabia. Disappointing as it may be that they bought huge amounts of SLV, maybe one of the worst products I've ever seen ever in my career, because just as a side note, the short position right now in SLV is 53.97 million shares,
wow.
Which is it's grotesque, it's ridiculous. And remember what the prospectus said, BlackRock said, there could come a time when there's not enough silver to cover those short positions, buyer beware. But the point is, we're seeing lots of silver that is being accumulated by the central banks. What is really different to me, as far as I'm concerned, is the amount of silver that is coming into the COMEX. And, last week I jotted down some numbers. In month to date in September, the number of contracts, and this was last week, I'm sure it's much more now, that stood for delivery was 10,599 contracts. Let's do the math real quick. 10,599 contracts times each contract weight being 5,000 ounces is 52,995,000 ounces. We'll multiply that, let's just call it by 42. That's $2,225,790,000 worth of silver has come into COMEX in the first week or so of the month. And this is what we've seen over and over and over again. The point I want to get across here is that when you have countries, Russia, China, Saudi Arabia, let's not forget about India, who's bought somewhere between 600 and 800 million ounces over the last 5 years. That's more than is on the COMEX and the LBMA combined. And now you see it happening in the United States. At this level, the people don't just have the most money that are standing for delivery. Now, when we say stand for delivery, mind you, this is going into COMEX. A lot of it leaves. A lot of it doesn't leave. So regardless if it's leaving COMEX or being put into an eligible account, not registered, meaning it's not available for sale, it's going into strong hands. To this degree, these people are not only the most well-funded traders on the planet, i.e. the central banks, the commercial banks, the very sophisticated traders that can stand for delivery on COMEX to the tune of billions of dollars every month since November, since the election, but they're also the most well-informed. And I think that's the most important thing to understand, is that the people at this level who swim in circles of 9-figure monthly acquisitions are not doing things just for kicks. They're doing it because they understand where we are going. They know the playbook. They are at the highest level of information. And that's what I take away from really where we're at this moment, is that price is relevant, but price is a tool of misdirection, allowing the big money to position before all of the people that you and I call friends outside of what we do for a living, talking about this stuff. The people who may be very smart, very bright, very well read, arguably just reading the wrong shit. And that's the problem. So most of the public has zero idea that there is a massive drive going on for gold and for silver in terms of delivery. Just as a side note, in the first 5 days or so, 6 days of the September contract, which is a non-delivery month, 3,626 gold contracts at 100 ounces apiece stood for delivery. So you're talking $1.5 billion there too.
Wow.
So in just the first week of September, you're seeing nearly $4 billion worth of metal stand for delivery. But this is what we've seen every single month. Now, we've always been an importer of silver, not always been, in fact, never, to my knowledge, been a net importer of gold. Both of them together signal a bigger move, a bigger trend, and that is that the smartest money in the world understands that there is a rush for physical acquisition of metal, bypassing the paper promises. So there you go. Crazy times, brother, and I think we're just beginning in silver.
Andy points out that central banks and BRICS sovereigns Russia, China, India, and Saudi Arabia are accelerating gold and silver accumulation, often buying ore and concentrates directly from miners, while the West relies more on paper vehicles like SLV. Russia confirmed BRICS talks on a new precious metals exchange with its own pricing, clearing, and auditing, reducing reliance on the Western system, while silver is gaining traction as a reserve asset, with reports of Russian buying and Saudi Arabia making first ETF-linked silver purchases. Analysts warn Western price suppression looks increasingly like misdirection, with BRICS building parallel commodity infrastructure to secure physical supply. Experts predict gold will remain strong, and silver could see outsized upside given its smaller market, though volatility and delivery bottlenecks may increase.
The only saving grace is, and maybe I would like to think they're not misinformed. See, if you and I bought SLV, we can never take possession. They can, because it's the amount that they purchased. You have to have a certain amount, and it's called a basket. If you are able to redeem a basket, which I don't know the exact amount, 20, 30, 40, $50 million worth, they can. So I'll give you an example. Kyle Bass, when he was running the fund for the Texas Teachers Union years ago, they bought, if I'm not mistaken, $1 billion worth of GLD. They stood for delivery. Saudi Arabia can do the same thing here. They do have the right to stand for delivery, and most of that metal, if I'm not mistaken, is held in the LBMA. So because they bought such a significant amount, they can stand for delivery. And maybe they had a reason behind doing that I'm not sure. For you and I, buying SLV is as dumb as a mud wall. Not only do you pay the capital gains for collectibles when you sell it, you can never take possession. It's custodied by JP Morgan and BlackRock. Of course, JP Morgan, as we have identified multiple times, paid the largest fine that the Justice Department had ever handed out at that point, $920 million or so, for manipulating the silver market. Well, and that was kind of, and the reason that I think that they got off so easily, I believe that this was done at the behest of the central bank, who gave them the green light to do this. And there are bigger reasons at play for holding down the monetary metals, but that's for another discussion. Simply to say, it was far more. In fact, you could argue that it was far more than just spooking. It was manipulation, and it was at one point thought it would be RICO charges, because in essence it's like the hitman kills someone, well, they can go after the mob boss because the mob boss ordered it. Well, the point of it is that who up the chain of JP Morgan understood this? Is it just the head trader, Michael Nowak, who was the sacrificial lamb that was put in jail for a couple of years? Or, I don't know. The point of it is that this is something that you can only manipulate a market, Ivan, for an extended period of time by pushing it in the direction that it is going. And I've been doing this for almost 36 years. Most of the time, the world didn't want gold and silver. They wanted U.S. bonds and U.S. stocks and real estate. They wanted what was, when things got scary, there was a rush to the dollar. What is happening now is that the big money around the world has become motivated, coordinated, and sophisticated, and they understand what's happening. The big money around the world largely being, when I say that, I'm talking the BRICS countries, in particular Russia, China, now Saudi Arabia, India. All of these countries understand, and they have been using the spoofing or the manipulation or the suppression of the metals market against us. In other words, hold the paper price down in the West, and then go all around the world and drain the supplies, especially off of exchanges around the globe that don't affect the price. The price is set in the West, so if you smash the price down on paper here and then buy it up there, and there, boy, that works out well. And they're smart enough to see the big picture. That's what they're doing. And then they go as far, and just ask yourself, the second largest producer of silver in the world, the largest producer of gold, don't sell an ounce. They fly all over the world and buy gold and silver in doré, which is a crudely refined bar, in concentrate, which is a byproduct of it, right from the miners, which completely disintermediates the amount and disintermediates the market and the commercial banks. They're thinking 2 or 3 steps ahead. They're playing 3D chess, we're playing checkers. So I think that this is something that is being used against us without saying so. They get it. I'll evidence it this way. I've spent a lot of time talking about the BRICS, and the BRICS grain exchange is something that is under development. And I listened to an interview about the guy who's running it a year ago, and he said, we here in the BRICS produce and consume in the global south more wheat than they do in the West. Yet we have no control over its price because that is controlled on COMEX. But with the development of the BRICS grain exchange, that will change. Now,
Wow.
They understand what we're doing with the precious metals, with the base metals. All of the things that we have suppressed for various reasons are now being used against us. It's jiu-jitsu. The premise being you use your opponent's leverage against them. And this is exactly what's happening right now, man.
Will central banks' increasing use of silver lead to a structural revaluation to that of gold? What potential effects may the establishment of a BRICS precious metals exchange have on shifting global pricing power and diminishing the importance of Western markets? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
Silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver right now with silver, where I think we could go all the way up and we could see it spike. And I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow off phase and shoot higher. Very similar to, what happens near the end of a move is you get a very strong parabolic move. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. And we're seeing it move into like silver miners and gold miners. You can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold, and gold has got this little pause that it's just had, and now gold will probably shoot up. So I think they're going to like piggyback on each other. That flows into miners and then flows into gold and goes back and forth.
With $44 as the next objective, silver is currently in a great setup for a breakout. It may reach as high as $49.50 an ounce in a traditional parabolic. The story is being driven by breakthrough technicals, tightening supply and industrial demand. According to Investing Haven's forecasts, silver will first challenge all-time highs, reaching about $49 in 2025. Money is shifting right now. Investors are pursuing silver and gold miners who have been rising in value, and gold has just rebounded, so they are taking profits there. In order to prepare for the next step higher, miners may now pause as profits are taken. This money might then turn back into gold. Chris Vermeulen is a market strategist and technical analyst. He points out that silver is in a good position. According to a recent commodity forecast, bulls are aiming for $44 if resistance is broken, and silver is now trading close to $42. Although silver is more speculative than gold, both are expected to continue to rise as a result of this rotation. Silver is breaking out, according to technical breakout assessments, both in terms of its absolute price and in relation to stocks from 4-year bases. In certain technical models, medium-term targets of $49 to $50 are repeated. At the same time, gold's consistent increase serves as a warning to markets about anxiety around the world. While IT giants continue to drive U.S. stocks to near high levels, internal weakness and exuberant sentiment point to the possibility of a significant correction in the near future. There are fissures in well-known industries, momentum and investor confidence are brittle, and valuations are high. Analysts warn that some profit-taking and sideways moves are typical following strong runs, in miners or metals. Although resistance has been breached by silver, further upside is contingent upon maintaining volumes and avoiding reversals. Chris believes when the cycle changes, investors need a strategy to identify trend reversals and safeguard their money. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Yeah, if we take a look at silver, we haven't traded silver just because gold, our play around silver was the silver miners. And so silver has done the very similar to gold as it's rallied up, and now silver's had a nice bull flag. It's paused. And so silver's breaking out and starting to run. So money's coming, I think, out of miners now and starting to go into silver. And then I think it'll bleed over into gold because silver is much more speculative than gold. So money's going to rotate probably from miners, silver, gold, and then kind of maybe loop around. These are very nuanced, small moves. But silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver, we're in a sweet scenario right now with silver where I think we could go all the way up and we could see it spike. And I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow-off phase and shoot higher. Very similar to, what happens near the end of a move is you get a very strong parabolic move. You cannot trust a move that goes straight up because usually it comes straight back down. Very similar to what happened just before the last financial crisis. It shot straight up, came straight back down, and then sold off for 65%. So I think we have that potential for it to shoot higher still. And of course, that'll be good for silver miners as well. But yeah, right now we're in that sweet spot for precious metals. And you and I have touched on this cycle graph before. If we look at the stock market, this blue cycle here, precious metals really come to life near a major market top. And one of the reasons is people are moving away from, the stock market in general, and they're moving into physical assets, something where they won't lose value or won't blow up on them as much. And industrial capital goods are actually doing really well. When we look at the industrial space, businesses are still bullish and industrial stocks are rocketing higher. Businesses think, things are good. CEOs and factory workers or management are upgrading their facilities, thinking, this is a little lull maybe for a lot of businesses before it goes higher. But I think the music's about to end. And when everybody's really bullish and they think businesses is just getting started, usually that's when the business goes for a nosedive. We go in for a recession and they realize they just spent millions on new facilities or assembly lines and all that stuff right when all their demand decreases. So there's a lot of things coming together. And yeah, there's a few key currents. I think looking at the big picture might be important. I think the stock market is getting pretty frothy. If we look at the charts, we'll actually take a look at the big picture and actually go to gold first. So gold, in a nutshell, I'm just going to flip to the monthly chart. Gold has been on a tear, for a couple of years. It's outperforming. It's becoming one of the best performing assets long term. last time we saw this was like in 2007, just before a major stock market and financial reset in the economy. Gold is kind of a barometer, a global barometer, like planet Earth and the people on it's like a beehive mentality. The whole world is nervous that something is about to happen. And they tend to move to gold. They move away from equities to some regard. They move away from currencies. They move away from even real estate, and they start to move to gold. They want something physical, something outside of the financial system. And gold is telling us that people are preparing for something bad to happen. We don't know what it is. We don't know, when the shoe is going to fall, and trends are going to change. The economy situation is going to change, but gold has just been on this tear, and it's outperforming and it's extending to the upside. That is an early warning sign to be careful for the stock market. But if we zoom in now and go to the overall stock market, I'll go to like the SPY, which is the S&P 500 ETF. We've obviously had a very nice rally coming out of the lows from this year. We had the big 20+% sell-off. Now the markets are pushing near hitting all-time highs, and really people are buying into this market up here. I think it's kind of camouflaged with, Oracle has now kind of just came out of nowhere. And, Larry, he's like, you never really hear much about him, it seems,
Mm-hmm.
Now he's the wealthiest man in the world and he's like silent. And Oracle came out, and I think it's going to revigorate, some of the tech space and make people even more bullish on the market. And of course, it jumped like 30+% the other day. And so the markets are getting dragged up mostly by the big techs. We are seeing some broad market rally. We're seeing small caps. They've been moving up and equal weighted, but it still is really the magnificent seven. And so the stock market is in an uptrend. You do not want to fight it. You just need to have a game plan so that when things do stall out and price starts to roll over, first of all, you can identify when the trend up has come to an end, and to have a game plan to at least avoid a crash or benefit from falling pricing. And then if we zoom into the shorter term here, Danny, we just look at the 30-minute chart, really over the past week, the stock market has gone from this lime green, this oversold market condition where it's sold off too quick within this uptrend. Lime green is an indicator, is part of an indicator that tells me when the market is too oversold, is usually when value hunters step in, bargain hunters or institutions, and they buy it back up, and you can see it's rallied. And it's done this a couple of times. When we just zoom back here on the S&P 500, it can get sold off, it can get into this oversold condition, and it gets bought right back up again. So we're still in kind of that buy the dip mentality. We did have an interesting scenario yesterday where we had this red indicator, get above this blue line. This is my FOMO indicator. This is everybody seemed to be piling into the market yesterday. They don't care what price they pay. They're using market orders, which means they're buying at market and they don't care what price they pay. When there's a ratio and this red indicator goes over 3, it's telling me that people are just moving in and they believe the market's going higher and they don't want to be left behind. And so usually after that, we have a little bit of a pause or pullback. And really it's kind of, as soon as we got up into that territory, the market's really been trading sideways for this last day and a half. We might actually see it pull back a little bit for another day or so. So, you look at long-term gold, be aware the music will come to an end at some point. We look at the daily chart. It's up, but it's a very weak market.
Chris Vermeulen emphasizes that gold has had a strong run recently and is now pausing in a sideways bull flag, which often signals it's ready for another breakout soon. While money has rotated into silver and gold miners, those positions may see profit taking, with flows cycling back into gold. Chris prefers gold, whether physical or through ETFs. They warn that if equities drop sharply into a bear market, even gold could face temporary selling pressure from panic and margin calls, but it usually recovers faster than stocks. Current conditions resemble 2007, where gold continued to rally even as equities topped, suggesting more upside before any broader correction. Let's dive into the interview.
No, so if we look at gold, all it's done is, we can look at the 30-minute chart over the past week and a half. Gold has had a very strong move. And after something's had a strong move, it's just taking a pause. I wouldn't say it's weakening. It's just taking a breather because it just had a hell of a run. It's exhausted. Right. There's just some profit taking. And so even when we look at the daily chart, which is very similar, we're just trading sideways. And it's a little tiny bull flag. It's primed and ready to shoot up literally, the next trading session, this thing could pop and run. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. And we're seeing it move into like silver miners and gold miners. You can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. And, I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold. And gold has got this little pause that it just had. And now gold will probably shoot up. So I think they're going to like piggyback on each other. That flows into miners and then flows into gold and goes back and forth. That's what I think is going to unfold here. The problem is we're coming to a turning point. And when things turn, I don't want to hold anything. So I still like gold the most, physical gold or through an ETF. I think that has got good upside potential here. I think it still has 10 to 20+% upside. I also think because I have to hold it for a year, I think bonds like TLT would be a good position as well. So the bonds could come to life and really start a nice move up. And eventually it'd be nice to sell gold. And because when the stock market does roll over, eventually gold will most likely pull back with it. But gold holds its value fairly well. It doesn't drop as much as the stock market. So I would say like gold and bonds would be those plays. If you had a gun to my head and said you have to buy and hold, it's probably the two that I would do. Short term, typically we see gold, like we could see the stock market top out and potentially fall 10, 15% from here. And gold keeps going up another 10 or 20%. But eventually when the stock market falls a certain amount and people start to get really scared, there's real fear, we actually enter a bear market, then gold usually doesn't stand a chance. There's enough selling and margin calls and fear that even people sell off the good positions like gold. And so gold naturally will sell off temporarily. But it's usually short-lived. Gold only gets pulled down during an extreme wave of selling. It could last a few months in the markets, and then it'll find a bottom way before the stock market does. So yeah, gold is not immune to a bear market, but it can rally in this particular situation. 2007, which is a very similar situation as we have right now, when you look at from price charts and what the dollar is doing and what gold's doing in the stock market, the equities market could sell off and top at any point here, and gold just keeps on going another 20+%. So that's why I like gold at this point.
It is more crucial than ever to have a clear plan in place to safeguard profits and handle reversals as global uncertainty increases and stocks reveal underlying fractures. How likely is it that silver will maintain its pace toward $50 without seeing a dramatic reversal if it breaks over $44? In the event that U.S. stocks undergo a more severe decline, may gold and bonds serve as the most secure hedge? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.